Nice. Thanks everyone for joining. Really excited for this one. Before we start, I have a mandatory disclaimer. We're investors in Ethena. I have a lot of my money in Ethena USD too, so might be conflicts. None of this is financial advice, etc. But yeah, I'm really excited about this one because I truly think stablecoins are the closest thing to crypto's killer app that we have. They're the one product that we all use pretty much every day, and arguably the only one we provide to the rest of the world that has like real, undeniable product market fit. And I think, yeah, I hold a lot of my net worth in stablecoins, a lot of it in USD, and I think as crypto natives, we can really feel that they're a superior product. You know, like a composable, programmable, censorship-resistant dollar is just a better product than its fiat comparison. The stats also show this. Obviously, stablecoins have grown to like 200 billion this year in a high rates environment. I think in 2025, in the late rate lowering cycle, we could see them grow to 400 billion. And to me, Ethena is the most exciting thing being built in the stablecoin space, other than some of the payment stuff, which we'll dive into as well. So before we start, maybe not everyone knows about you and like how Ethena works, what the vision is. Could you just give us like your background, briefly how Ethena works, the mechanism behind it, and then also like the big vision, the internet native money vision.
Sure. Hey everyone. So I'm Guy, founder of Ethena. Before starting out with Ethena, I used to work in traditional finance. So I was at a hedge fund that was looking at financial services businesses. I actually met Zaid when I first came into crypto in 2020. So it was, when DeFi summer was kicking off, I had no idea what I was doing, sort of subscribed to their research pieces back then. And nearly joined Delphi as part of the business, but met a few years later with Ethena after that. The origin and like Joseph's story behind Ethena actually came from an article that Arthur Hayes put together at the beginning of 2023. The article was called Dust and Crust, if anyone has come across it. And in there he outlined his vision for what he thought could be the most important product within crypto, which is an idea of like native money. And really like the core idea here is like, can you take crypto collateral and use derivatives within crypto to hedge out the price exposure of that collateral, which allows you to issue this thing that we call a synthetic dollar. So we don't call it a stablecoin. It's something that's like dollar adjacent and represents a dollar, but obviously looks extremely different to its construction versus a normal fiat stablecoin. And yeah, I read his piece, was pretty inspired by the idea. I think it's something I've been thinking about before he published that piece. And to me, it was just a bit of a signal when I read that I should sort of take a risk to jump out and start thinking about something like Ethena. And yeah, in terms of what we've sort of done since we came to market, we launched at the beginning of 2024, so it was in February 24. Since then, grew to around $6 billion in supply, so that was the fastest growing dollar-denominated asset that we've ever seen within crypto. And I think one of the interesting byproducts of what I described of taking in crypto collateral and then hedging it is that you're actually capturing a pretty interesting interest rate in crypto, which is known as the funding rate. So for those of you who aren't familiar, when you're trading derivative instruments, whether it's futures or perps, there's usually an interest rate that you're paying to be long. And so you can really think about Ethena as taking the other side of all of the DJs within the market who want to be leveraged long the entire time. And we're taking the other side of that trade and providing them capital, which you can get an interesting interest rate that's attached to that. So you've seen the APYs on Ethena's USD range from anywhere from like 5 to 65% through the year as like conditions change. And really that's one of the more interesting things I think we brought to DeFi, which is this idea of internet money, new DeFi applications to build upon and start to build like net new financial primitives on that core asset of USD. So yeah, that's the story so far.
Nice. Yeah, I really like that line from your initial roadmap blog of the total addressable market for programmable dollars, the entire world, which I think is true. Like the TAM for internet money is actually trillions. And you, like you said, you launched Ethena in February 2024. You grew to 6 billion, the biggest stablecoin outside of USDC and USDT. You had like an insane launch year, going to 100 million in revenue. I think second fastest ever after Come Fun. You're at the center of a bunch of DeFi applications. You partnered with BlackRock. How do you like keep this growth going in 2025? Like, it sounds like in 2024 you basically were very focused on DeFi and also like collateral and CeFi. Maybe you can talk a bit about that. how do you have to change your approach and your strategy in 2025 to keep this kind of insane growth going?
Yeah, I think you touched on that. I think the three components of growth that we sort of saw DeFi, CeFi, TradFi as three separate components. I think starting in DeFi always makes sense. I think the risk appetite there is the highest. People are willing to try new products, and that's always a good place to go and bootstrap what you're doing. I think one piece that other stablecoin/dollar issuers within the market had always ignored through the years was actually just how big and important CeFi was as a distribution channel. So if you look at the history of stablecoins and why is it that Tether won over the last few years, I think it's actually a pretty simple answer, which is they're the denomination for BTC and ETH pairs on Binance. And so when you can attain that status of money within centralized finance, and people need to buy Tether if they're going to be buying Bitcoin or ETH on the most liquid venues, it's just such an incredible mode that you can establish around doing that. And so that's one piece that I think we took a slightly different approach, which was other builders who were in DeFi before sort of saw CeFi as this really ugly piece that they don't want to interact with, and they sort of ignored entirely. But if we just look at the numbers, I don't know how many of you think, how many people do you actually think are really interacting on a daily basis with DeFi in a serious way? I think it's like single-digit millions, maybe. While Binance has 250 million users that are sitting on that platform. So like the scale of opportunity to just touch and get your product in users' hands, I think it's just an order of magnitude larger within CeFi. And so that's one focused effort that we had, which is to try and move the asset into CeFi, and it was a core piece of sort of the growth strategy towards the back end of last year. So we actually flipped USDC on Bybit, which is the second largest exchange for derivatives, and that's a huge area of growth where we sort of started to tap into that. But it's not a great answer this time, just a bit more than saying over there. I think
that's not just getting USD pairs listed, but also getting USD listed as collateral, which you can then have this like yield-bearing collateral that you're trading perps with, right?
Yeah, exactly. So I think it's not that well known, but $50 billion of Tether's total supply is being used just to margin derivatives on exchanges, which is a pretty mind-blowing number. And I think the value proposition here is like, if you're going to be using collateral for something, for trading derivatives, to have your collateral paying you instead of getting zero is just a pretty compelling offering for professional trading partners, even retail traders as well. And then I think the last component that we're touching on, and it's really the focus of what we're doing in 2025. So I released like a roadmap piece on my Twitter last week, which sort of outlined this idea of convergence between crypto and TradFi. It's really trying to think about, we start to see these trillion-dollar asset managers come into the space with ETFs, whether it's like a BlackRock, Franklin Templeton, all those kind of guys. And when you go and speak to those teams, they've got 50 to 100 people sitting within those entities, and all they've done is launch an ETF, and it's like, well, what do we do next? And there is more that they want to do outside of just having an ETF or BTC and ETH. You don't need 100 people to do that. And I think from our perspective, like, it was a line that you touched on, which is, really if we think about the size of just like global asset markets within the world, fixed income is the largest asset class by far versus anything else. So it's like an order of magnitude larger than equities. And if you think about the largest markets, whether it's mortgages, corporate bonds, sovereign debt, all those different things, it's really a dollar with a yield. That's actually the product that you're delivering to people. And so I think the natural evolution of where we see those firms finding the most interest within crypto is, can we actually package up the most scalable, highest risk-adjusted return of a dollar within crypto and export that out to them as a product, because it's something that they're familiar with and can compare to stuff that they do every day. And so really, yeah, that's the next step for us, which is, I think that there's still $5 to $10 billion of growth within crypto, just doing the same thing that we've done, and the market's sort of growing in the next year. But I think if you're going to push to sort of $20 to $30 billion in size, you need to be tapping into those new pools of capital, and it's just something that I'm quite focused on, because I think a lot of DeFi and a lot of crypto is quite circular, right? Like, we're just moving the same chips around, swapping like ETH to government shitcoins, and then back to each other, and like levering up some ETH and de-levering it. There's not like actual net new flows that are coming into the space outside of really like money comes into an ETF to buy Bitcoin, or money comes into a stablecoin to do something with it. And we really want to be that third pillar where there's a real reason for new capital to come from the old world into like the internet financial system. Yeah, through us.
Absolutely. The cool thing about Ethena is, yeah, you're kind of turning like crypto speculation and animal spirits and packaging it into this like really clean yield for TradFi. I think a lot of people don't understand that because they're like, well, why can't these funds and hedge funds just do the basis trade themselves? Like, why would they take custody risk with you or whatever to do this? And maybe you could just touch a bit on that and like why SUSD will actually always offer like a higher yield than what you can get by yourself because of the inherent leverage with unstaked USD.
Yeah, I think that's one component. I think people also underestimate what just making something simple for people actually does in terms of demand. So we see the same things in ETFs with equity markets, right? Like you can own the S&P yourself, but to sit there and construct and rebalance and stuff like that, people don't want to do that. They want to live their normal lives and have some sort of exposure that's managed for them on the other side. I think the bigger piece that's missing there is, I think Lido is a very good example here, where I could say the same thing to you, which is you can go stake your ETH, right? That there's $40 billion sitting in Lido. Why is that? A, they made it easier for you to do that, so that's one component. And B, it's because they made it collateral, and that's actually the most important piece, which is, yes, you can go and do this yourself, but you cannot take it as collateral, put it onto Argo, do something interesting with it, put it onto BUIDL to trade derivatives and all those different pieces. And so it's really when you tokenize it and make it collateral, there you unlock things that just were literally not possible for people to do themselves.
Yeah, very cool. And yeah, in your latest piece, you have this mental model that I really like to think about. What are the factors that make up stablecoin adoption? Like, if you had to grow, like when we see stablecoins growing to 1 trillion or multiple trillions, what makes up like those factors of adoption? And you talk about kind of 4 different use cases, which is exchange trading and collateral, so centralized exchange using it for trading and collateral, developing world store of value, so kind of the Tether on Tron, like using it to escape their own fiat currencies, savings tool or investment product, and then payments. I wonder if you can just like run through those and like talk about what they are, the market size, and maybe we can dive into each one, kind of how you would grade Ethena doing on it now and how you're prioritizing it for the future as well.
Yeah, sure. So I think the trading use case was like the original use case of why stablecoins existed, right? Tether was born because people didn't want to hold Bitcoin the whole time. They wanted something else to swap out of when they were trading on exchanges almost 10 years ago now. I always think that's going to be an important point, like part of the use case. But if stablecoins are going to get to north of $1 trillion, I think it has to play a more real role in the actual financial system outside of just like speculation within crypto. So I think that's like the most dominant use case as you see the world today.
What's the size of that roughly, like 70 billion or something?
No, I think it's probably close to 130. Like all these numbers are slightly rough. I think the way that we tried to segment this was just saying Tether that's sitting on Tron, I think is a very good example of like developing world use case for trying to get access to dollar rails, basically, if you're not in the US. And I think that is a very clean way to just segment. If it's on Tron, most of the time it's going to be used for that use case. And then if you sort of just subtract that from like the total amount that you see at 200 billion, you're left with something that's close to like 120 to 130, because other use cases are pretty close to zero. And then yeah, I think the 2 emerging categories where you can obviously see a use case where you just don't see that much use right now is really a sort of like savings products, and then the other one is this idea of payments. So on the savings product side, I really see that as like a core DeFi sort of value proposition and product, and really I only see Ethena and MakerDAO at scale providing that product. In the grand scheme of things, it's not that big. It's like $12 billion between ourselves, maybe a few smaller ones that sort of add up a bit more than that. I do think that this is the avenue where billions of net new flows can come in from traditional finance into a product like that. And I think that's especially the case when interest rates start to fall in the real world. So I think one of the most powerful dynamics here is that crypto rates tend to exhibit negative correlation to rates in the real world. And there's an intuitive reason for that, which is as rates start to come down to zero, people speculate more on crypto. All the stupid shit that we saw last cycle in 2021, people do crazy things with Macedo at zero, and naturally like the demand for leverage within crypto picks up. And so that's actually a really powerful point, which is you've got trillions of dollars of fixed income, which is going from 5 to 4 to 3 to 2 in the real world, and then crypto rates are going from 10 to 15 to 20. That negative correlation is extremely powerful to people who sit outside of crypto, and your ability to package up those types of products from DeFi to export into TradFi, I just see as a huge growth opportunity relative to the size of where the market is right now. And I think the last piece, and it's an area that we haven't played in that much.
So that's like packaging a dollar yield for TradFi, basically.
Yeah.
Like that use case. For TradFi and for just people around the world as well, I guess.
Yeah, it could be retail, exactly. And I think a lot of the dollars that we see in DeFi are those kind of people just accessing it there. So I think that also starts to encroach a little bit on the Tron Tether type of use case. But I think they're more deeply embedded for payments in the development world than a MakerDAO or anything else. And then I think on that final category of payments, you've obviously started to see people like PayPal, those type of like Web2, fintech type of incumbents start to take stablecoins in a very serious way now. I think the issue here is that stablecoins represent such an enormous shift in the business model of what a payments company does that it's actually quite scary to pivot your entire business to do that. These are multi-$100 billion businesses, and it's a flows-based business, so the more transactional volume you see going through these things, you're making a fee every single time that someone transacts. It's not a balance sheet business it's like a stablecoin, which is making interest out of how many assets are actually left to make. So it's a very dangerous thing actually for payments companies in the world to say we're going to start using stablecoins instead of the current business model, because it's totally different. You start to look like a bank, not like a payments company. I think when we speak to people within those firms, they are quite convinced that over some period of time, that use case for payments will be north of $1 trillion quite easily. It's just a matter of how long it takes to get there, because you have this natural friction of people having to decide, do I want to sort of cannibalize my own business model as it exists now to sort of deliver that? But I think everyone recognizes that's probably the end game that you're going to. So yeah, I think to answer your question more directly, when people are throwing around these numbers of, I think stablecoins are going to be at 500 billion, a trillion, 2 trillion, that necessitates the real world engaging with stablecoins in a real way. It's not going to be people are using USDT or Binance a little bit more than they were before. That's kind of like the real bulk of what people are doing, like using stablecoins for now. But I think it's going to just constitute a much smaller part of the market if you do get to those numbers in the future.
Yeah, I guess the first two, like the integrations into CeFi and the global store of value, it's kind of you need to gain market share versus Tether, and then the last two are kind of growing the overall pie. And you mentioned on the payments one, you recently announced this like Telegram mini app that's going to be powered by SUSD. Do you want to maybe talk a little bit more about that, or why you chose to do it that way, I guess?
Yeah, sure. So I think when you're a startup, you need to be like extremely honest with yourselves about what are you good at and where can you compete and where can't you compete. So I think there's been a few stablecoin issues that have come to market this year, and they're like, hey, we look a little bit like Circle, but we're going to be the payments type of stablecoin. I think we were discussing a few names before we came on stage earlier. The problem with that is that like when you're facing off to an entity like a PayPal or a Visa, they don't really have an interest in working with a startup. They're just going to do it themselves. They're resourced enough. You know, they have confidence in their own brand. Why do you, as a shitty startup, have any? Why are you so arrogant to think that you can even like attempt to address that market? So I think for us, the approach has to be like, what can you actually do better than other people by a factor of 10x, and you need to lean into those like those pieces. And so we think about like, what is a stablecoin? Where can you actually compete? It's supposed to represent the dollar, so you can't compete on that. You've got to be stable. If you're not stable, then you're not going to have any users after a while. So there's no real way to differentiate that. Liquidity, there's no way as a startup that you can fight Tether or Circle on liquidity. They trade hundreds of billions of dollars a day. How do you get from zero to that level to convince someone, come hold my new stablecoin instead of USDT? And then the last axis that you can think about is return, and that's kind of like, that's where Ethena is leading into, which is we'll pay you a higher interest rate to hold this dollar than you would with Tether. And so the reason I'm giving you all this context is because we as Ethena, I know I don't have as good of a brand as PayPal, and I'm not going to beat the payment stablecoin that all these guys want to go and work with, and that's okay. I want to go win different pieces of the market, and I need to make sure that I do that. Having said that, there are interesting areas within crypto where I think payments are going to become more integrated, and that's why I think this Telegram piece is so interesting, which is it sits adjacent to the payment system that exists right now. You're not going head-to-head with PayPal and Visa and MasterCard. You're trying to find people, a billion people that are using the Telegram app already, and then adding payments functionality to an app that already has distribution. And so the vision that we have over there, for anyone that's used USDT, there's in the custodial wallet that you find within Telegram, you can hold TON and Tether at the moment. It's really the only two core assets that you can have there. We're going to have USDT sitting alongside Tether there, which is basically your savings app within the Telegram app. So you can just hold USDT, get the yield that I was describing, and then double click to pay with Apple Pay on the other side. whenever you're buying something. And I sort of think about that as really the one product that a billion people can actually use that is crypto-enabled, right? Everyone on Earth, what is the basic financial function that you're asking for 95% of your life? It's just holding the money in the bank, getting a bit of interest, and then being able to spend it. That's what 95% of people want out of finance, and maybe getting a mortgage. And I think being able to have that in and out with that level of distribution, powered by crypto rails, is one of the most exciting products that we bring to market.
That's super cool. I've never heard that whole thing. That's really interesting. So are you going to be able to send it on Telegram like you send Tether right now, like in a text message kind of thing?
Correct. To like names instead of wallets, which is just really easy.
Yeah, that's really cool. And then, so that makes a lot of sense. You're going after like these, rather than trying to compete with PayPal and their own stablecoin and stuff. So is your mental model that PayPal and Stripe should have their own stablecoins?
For sure.
I mean, obviously PayPal already does, but you think they're all going to make their own stablecoins, and don't they still? Is there a world where you try and get them to integrate USD just because it pays a higher yield, and if that's their business model, they can clip more of the yield, or you just think? Because right now, I guess right now the status quo is you don't have to pay any yield, right? Like Tether, USDC, they don't pay any yield to their users, so you can just keep the entire treasury yield for yourself, and I guess that's what Stripe and PayPal are looking at. But if Ethena kind of changes this meta, right, and then it kind of changes because people will expect a yield from their stablecoin, and then in that case you can only clip a share of that, and in that case you want to like integrate that highest yield possible, right? So,
yeah, and there's definitely a version of the world where we sit alongside what they're doing in a much smaller balance. So you might have a PayPal with $100 billion of PYUSD, which represents their entire balance that they're sort of facing off to the merchants on the other side, and maybe 5% of that is sitting in USD, where they can just try to extract more out of the float that they have already. I think the easiest way to think about these things is that if those payments companies decide to do that at scale, they just start to look like normal banks, basically.
Yeah.
And T-bills might be one asset that is sitting on the asset side of their balance sheet, and there might be a whole host of other things. We could be one, yeah.
That makes sense. That makes sense, okay. Is there anything we missed on some of these, like the savings side, or anything else you want to talk about on before? Maybe CFI, actually. So you got integrated into Bybit and two of the other big five, which ones are, and like, obviously,
Deribit.
Okay. And then Binance just announced their own thing. Like, what do you think of that? How do you end up? I guess Binance is the sort of the big boss in terms of CFI. How do you get integrated there? Is it just users demanding like the higher yield that they can get with Ethena?
Yeah. So for those of you that didn't see, like, Binance came out with their own BUIDL, which is like a copy paste of Ethena. And Binance are one of our largest investors, by the way. I think the difference here, and I think this is a really important point with stablecoins in general, is that you need to be neutral infrastructure across all of the venues. So I think this is actually a strategic mistake that Circle is making with Coinbase, which is when you get too close to a single exchange, other exchanges do not want to work with you because they see that allegiance, and it's just not something that they want to support. So one thing that Tether's actually done very well through the years, despite obviously originating from Bitfinex, is that they're genuinely like neutral across all of the exchanges. They don't share yield with anyone. It's the same deal for everyone, and so everyone's comfortable getting in bed, knowing you're on the same terms, and there's actually a genuinely neutral party that's sitting in the middle. Binance have launched their own stablecoins in the past with FDUSD. I think that's been a resounding failure, to be honest, like relative to the size of the business. I think it's sitting at $1.5 or $2 billion right now. And the lesson there is that when you try to do this all in-house, it's just a fundamentally worse product for users, because even if you think about it from like a trading fund perspective, when you're needing to move collateral around from a Binance to an OKX to a Deribit quickly, when you're doing high frequency market making, all that kind of stuff, to swap out of FDUSD into USDT to then move it to OKX is just such a friction that you don't want to deal with. You want to have the same collateral that's just being sent to different venues and used in all these different places. So I understand, Binance has an approach which is they try to do things in-house the whole time where they can, and then eventually when they realize that I think it's the worst product for users, which is I can't send this to another exchange and it has a worse return profile versus Ethena.
Because they can only use the Binance OI, right? They're incentivized to only use the Binance OI rather than tapping into every single central exchange.
Yeah, correct. And so, one piece around this is that obviously as you grow and you put more shorts into the market, you reduce the funding rate within the market. Yeah, that's like obvious. As Ethena gets larger, the interest rate comes down. The problem is if you just do it on one exchange, you just start to completely depress the interest rate in that exchange relative to the rest of the market. And so if their own product grew too large on their own exchange, the users are just getting a worse and worse deal, which is like, I'm getting paid 5 on Binance, while Ethena is sort of paying 15 by aggregating the rest of the market. And Binance also typically has the lowest interest rates in the whole market because it's sort of like the venue for price discovery and the largest. And so in essence, you can see it in the data, like Ethena's maybe 500 basis points wide of Binance's product, pretty consistently.
Yeah, cool. And then speaking of neutrality, let's talk about Ethena Chain and your plans there. Because last year you unveiled this vision behind Ethena Chain or Ethena Network, I think you're referring to it now. And in the piece you said, once you've created money, you now have the most powerful product in crypto as well as the killer app. The natural extension of this core product is to build an economy and network upon it. Most base layer infrastructure starts as a platform and then attempts to bring applications to their users. We believe this is suboptimal sequencing. Ethena starts with the killer product of money. This core product provides the lifeblood asset for many other financial applications to build upon, many of which are already integrated with the benefit from the existence of USD. So this is a thesis we believed in for a long time. Hyperliquid kind of showed it to be true, right? Start with a killer app and then expand to the network, albeit another killer app of exchange. How's the progress going with that? How are you seeing it? Because there is that tension that you mentioned before, right? Of you want to be neutral infrastructure that everyone can rely on, be neutral. When you start having your own chain, your own infrastructure, they can start to see what's competitive. So like, how are you managing that, and how do you see the vision for Ethena Chain now?
Yeah, so we'll have a chain that's like very purpose-built for a very specific use case. It's not supposed to be a chain for like a generalized L2, as an example, where we're saying like come build gaming, come build like consumer apps, come do whatever. It's really like hand-picked apps that don't exist right now that we want to see exist and can be uniquely enabled by our core product. So we put out like a list of like 8 to 10 different app ideas that we think don't exist now that we'd really love to see built and can sort of help to grow USD supply if they are successful. I think the other key piece to point out here is that as a big part of this, we do have applications that are building on Ethena but not necessarily being committed to be on that chain. I think this is something which is a very different approach, which is some app builders now are much more opinionated about what is the piece of infrastructure that they actually need to deliver the best product. I think your Hyperliquid example there is very good, where, for example, with the CloudDex, you almost certainly don't want that to be on generalized block space on an L2. You want to have your own app chain to be able to customize it according to the needs of the exchange. And so the way that we're sort of designing this and having apps built on us is that you might want to use USDE, but it doesn't necessarily need to be on this chain that we're sort of putting things together on. It might be that you're in a totally different piece of block space, but sort of still building on Ethena's core product. And I think that that's one piece in terms of how we address this potential conflict, which is you want to be an asset that all these new chains that are coming to market uses for their go-to-market. So Berachain, for example, now is coming out and just opened up a pre-deposit. USDE was like the first core dollar asset that was there to deposit there. And it's actually a very powerful go-to-market for us, which is every time you see one of these new chains coming to market, they want to work with you to actually push your asset for you, which is great. You never want to ruin that relationship, and as part of that, there might be an app on Berachain that says we want to build an USDE, be part of this idea of an Ethena network, but Berachain is our choice of chain for whatever reason. So we're trying to make sure that we don't sort of cross those things off.
Makes sense. Yeah, everyone right now wants to integrate you because they don't want to compete with they don't want to have to pay more than 10, 20% that you're paying in SUSDE. They want to integrate with you and then offer their own incentives on top of it, which kind of makes sense. Do you want to maybe talk a little bit about USDTV and the partnership with BlackRock? Why like launching this kind of on-chain treasury was so important for Ethena, why it makes sense, like how you see it as part of the product suite. And then I guess now that dispels the biggest point of FUD about Ethena, this negative funding thing, what do you see as the biggest risks? Yeah, what keeps you up? We have a minute, but I think we can go slightly over.
Yeah, I think what Zay's getting to is when I was describing the interest rate that's attached to Ethena's product, you do see periods in time where it's not always positive, it does go negative, and so there was this like risk that essentially an interest rate that was paying me 10, 15, 20 might go like negative 3, 4, 5 for a period of time, and how do you sort of like solve for that? We've introduced this new product that sits alongside USDE, which is called USDTV. It looks and feels almost exactly the same as Circle's USDC. And essentially what Ethena can do now is exit the positions that they were in as part of the back into USDE and be able to transfer over into our own sort of normal fiat stablecoin that sits alongside it. I think that what we're trying to do there with that product is I view like the business model of Circle as becoming extremely challenged over like the next 3 to 5 years. The last few years have been like an anomaly in terms of how much yield they're able to extract from their product, and I think it basically converges to a business model of like an asset manager who's put in 10, 15 basis points on the assets that they're holding rather than 200, 300, 400 basis points. That is my view of where I think the world is going, and USDTB is there to undercut that and get to that end state immediately, which is we go to all of the exchanges that we're working with and we tell Binance or OKX or Bybit, we tell them you can have 95% of the yield that's sitting behind this product, you can keep it to yourself, or you can give it to your users when they're trading on your exchange, but we are going to have a razor-thin margin that's sitting on that product, because we want to give you a product that you're happy with to undercut USDC and Tether. Why are we doing that? It doesn't make any money, all those different pieces. Well, we want to do that because you want to get your distribution partners happy with you as an entity to then push USDE, where we make a ton of money, more than $1 billion of revenue as of like last month. And so really it's a product that sits alongside USDE, where we can get distributions on site and on, like in supporting us so that we can actually have USDE distributed into more places. And then I think from a user perspective, we also recognize that USDE's risk profile is not for everyone, and being able to offer everyone like a full spectrum of dollar products with different risk profiles is obviously just better for them. Yeah.
Nice. I think we're out of time. Really appreciate that. That was really, really cool. And thanks everyone for listening.